Welcome you all to the Thursday webinar, and this is Akshay Menon, analyst at BLB Bazaar. Along with me, we have Mr. Arun Malhotra, who is the founder and managing partner at CapGrow Capital Advisors LLP. Hello, sir.
Yeah, good evening. Good evening, Apsara.
Good evening, sir. So the topic for the day is special situation strategy, low risk with superior returns. So before moving on to the PPT, so let me have a brief about Mr. Arun Malhotra. Mr. Arun Malhotra is the veteran in the capital markets with more than 30 years of equity experience. He's a passionate about stocks and investing since childhood and gained trading research experience at BLB Ltd and DBS Securities in early 1990s. Mr. Arun worked on the buy side with Manning and Napier, New York, from the time period 2003 to 2005. Around $26 billion AUM, and US hedge fund for the time period 2005 to 2013 of AUM $300 million, based out of Mumbai. He has also been involved as a consultant to European Investment Bank for their business in India, along with managing property funds in listed equities. So before moving on to the PPT, I request the audience not to ask any stock-specific questions and to put your questions in Q&A box. So over to you, sir.
Yeah, thanks, Apsara, and thanks everybody for joining on a Thursday evening. Special situations is very close to my heart. I have been doing special situation investing since 2005. And I have realized that this is something which gives you higher returns with lower risk. I am going to share a brief presentation on special situation investing, which will highlight the key features, as well as it will help you think why it is low risk and why the returns are superior. That's my objective of this presentation. Let me share my screen with you. Yes, I hope you all can see my screen. I'll come to, as Apsara said, CapGrow was started in 2018 and we run a SEBI registered PMS. What is special situation? Special situation is a corporate event. It's an event which is structural, which is non-operational, and that impacts the value of the firm and its securities. When I say corporate events, what are the corporate events that I am referring to? I am referring to mergers, demergers, spin-offs, buybacks, delistings, broken IPOs, restructuring and distressed securities. Broken IPO is a very unique word. You may wonder what is a broken IPO. We have heard IPO, but what is a broken IPO? See, when there's a situation like Zomato, which is 1/3 of, or maybe half of the IPO price, Policy Bazaar, which falls down 60-70% from the IPO price. Similarly, Nykaa. So these are IPOs that come around 40% of their IPO price, and according to this strategy, they merit attention. I'm not saying they merit investment, but they merit attention. This restructuring distressed securities are something very common, and we all play during the cycle. So special situation investments is a completely different strategy from a pure vanilla strategy. When I say pure vanilla, it is neither value nor growth. It's a highly predictable strategy. When I say predictable, I will come to that part and stress why it is predictable. It is niche and differentiated strategy from the others. It offers returns regardless of how the indices perform in the medium to long term. What I am trying to say here is that in this strategy, we are focusing on the corporate event itself. whether it is a merger, demerger, how that event changes the capital structure of the firm, it changes the earning profile of the firm. And hence, our focus, our analysis is on the happening of the event and not so on the operations of the firm. We are not going to predict how the margins will behave, what the raw material cost would be, what would be the cost of the iron ore next quarter, how the copper would behave in the next 12 months. Because according to us, we don't know. We don't have the best handle. Even best of the best analysts do not know how the future will look for these commodities, because these commodities are spread across the world. So it's very difficult to predict their prices, and hence, because these commodities impact the margins, so very difficult to to estimate the margins and hence the profitability of a company. This special situation investing is huge. It's still at a very nascent stage in India, but it is one third of the total market in the US. Uh, so special situations are characterized by catalytic events. As some of us, if we have studied science, we know what catalysts are. They increase the pace of a reaction, of a chemical reaction. So, in our parlance, in our stock market parlance, catalytic events means these events will help unfold the value of a stock. So let's say there is, whenever we invest, there is a difference between the price and the value. How would we bridge the gap? These corporate events help us bridge that gap, and these events help the price towards that estimated value. There are two drivers of stock performance for our special situation strategy. One is corporate event, which I mentioned, and second is buffetology. So we apply a second layer, which we call it a sanity check on the event or on the company where we are going to invest. Even though for us, it doesn't matter what the operations of the firm, how they will, the focus is on the corporate event. But as a sanity check in India, especially, because a lot of times we are pitted against the promoters. Sometimes there are mid-cap companies. We need to make sure that whatever changes are happening in the balance sheet, whether it is a slump sale, whether it is this, due to some preferential issue, cash coming into the balance sheet, that cash is utilized in the best interest of the minority shareholders. So corporate event plus the second layer of buffetology gives us this special situation investing. Investment horizon, it can be 3 months to 2 years. And as I said, it will not depend on the market beta, but the progress of the events and regulatory approvals. I want to, pause here and, request you to think, what does these regulatory approvals? Is it a risk? The regulatory approvals, the timeline is the risk, not the happening of the event. The events, instead of, let's say, I expect 6 months, 9 months to happen, they may take around 12 months, 15 months. So that may impact my IRR, that may impact my returns, but the risk of happening that event is very minimal. So the risk is not in the event, not to the event, but the timeline, and hence IRRs might differ. So overall, special situation, very simple form of investing. You don't have to invest you don't have to think what is happening to the US interest rates, how the geopolitical scene is going to, flow. But it is just an event. Sometimes, rather a lot of times, one time even in the event in the history of the company, which impacts the stock price. These are high conviction actionable ideas. When I say high conviction actionable, we participated. Okay, there was a buyback 6 months back where the stock was ruling somewhere around 68, 69, 70 rupees. Buyback was 85 rupees. So there is a clear, you can say, arbitrage where your stock absorb, the around 70 to 75% of your stock would get absorbed in the buyback. Plus, the business is improving. And second layer was the promoter was not participating. So the promoter was enhancing his stake. So when I used predictable in my first slide, predictable means I know my buy price is X, which is close to 69.70. What is my exit price? 85. I would be, settled with maybe 15-20% of the stock, which does not get accepted by the company in the buyback. And then second layer of sanity check will give me what could be the worst value. A lot of times we have seen promoters getting changed. Uh, these new promoters coming and bringing in fresh capital into the company. So these are capital structure changes which we love, primarily because of two reasons. These capital structure changes lead to increase, strengthening the balance sheet, increase in cash or reduction of debt, strengthening of balance sheet, and a new management which brings in positive incremental changes in the business profile and subsequently the profitability of the company. Risk, as I said, regulatory risk, but till I have been doing this special situation investing since 2005, and not even one single event has been cancelled by the regulatory authorities. There might have been tweaks here and there, but they get delayed in 70% of the cases, but there is no risk to happening of the event. So, I keep on getting these questions whether these opportunities are scalable, whether you get it at all times. I would take the audience back to the bottom, the trough in the last 3 years, which was March, April 2020 post the COVID. The valuations were so depressed. In those times, normally companies which have better potential, good future, strong balance sheets, they come and do buybacks or delistings. So we had Vedanta coming out with a delisting offer in April, May 2020. We had another IT software company, which was �EXAware, coming out with a delisting. The delisting actually happened 70-80% above the price when it was announced. So in times of distress, companies with strong management, strong balance sheets, come do buybacks, increase their stake, or even do delistings. In good times, when the markets are bullish, a lot of businesses either they do slump sale or they get in cash, distribute it to the shareholders, or mergers happen. A lot of companies use their stock, use their security, and do a merger, through a swap ratio with another company. There are also demergers because a lot of businesses become bigger. Some of the businesses are unrelated, and these conglomerates or these large companies try to demerge their businesses, which enhance shareholder value. In distress times, we get distress securities. There have been a lot of steel companies which were available in 2016-17 at a valuation where now the current EBITDA is more than the market cap which was there in 2017-18. So the stock has been 10x, a lot of times 5 to 10x if you catch a distressed security at the right time. Broken IPOs, I already gave you example where the IPO, the stock falls significantly post the IPO for some or the other reasons. Same way with restructurings. A lot of times, because of higher debt, restructuring happens either through with the bank or the bond. So those situations interest us, and we believe they create a lot of value for the shareholders. These events, these situations, special situations, happen across these various sectors. You can't say these happen in only maybe commodity or cyclical. they happen across the sector. What is the life cycle of these events? Normally, it is anywhere between 12 to 15 months. And once, lot of times, what happens is once the event gets fructified, that means there's a change in the management, two companies get merged. Then, 12 months after that merger, you see a huge jump in the profitability, a hockey stick kind of a scenario because initial 6 months happen are normally involved in either kitchen sinking or trying to rationalize the operations, rationalizing the workforce. And post that, you start reaping the benefits of the merger, both on the cost front and both on the revenue front. When I say cost front, there will be cost synergies and there could be revenue synergies also. So you have to wait that, and that's why we say 12 to 15 months after the event gets fructified. So overall, maybe 9 months getting the merger approval, 9 to 12 months, and then another 12 to 15 months. So in this case, situation of a merger, you probably would have to wait for 24 to 30 months. But if it's a delisting or a buyback, these events happen in 3 to 6 months, and they just finish it off. Buybacks max to max 3 4 months. Delisting, we have seen this year, delisting of DFM Food, which happened. Again, it happened close to some 70 80% of above the price where it was when it was announced. Uh, what is the advantage of this investing? Why should I go for special situation? This is a very common thought which comes to the mind. Why not just stick to plain vanilla? I think this strategy, what we are trying to do is we are trying to, as I said, it's predictable. This strategy ensures that the systematic risk is taken out of the portfolio. When I say systematic risk, what it means is because the focus is on the corporate event, we are not bothered whether the US interest rate goes up or down. We are not going here, sitting here, let the Fed do their role. We are here just analyzing the corporate event and hence the impact on the company. Since we are not focused on the operations. This strategy has low correlation to the general market movement. When I say low correlation, so in the medium term, if it's a catastrophic event like COVID, all the stocks get hit, and a lot of times that is an irrational movement. But in the medium to long term, this strategy has got very low correlation to the market movement. So, as I answered, why is this strategy better than a small or mid cap or a large cap? Is because it offers predictable returns, returns which are uncorrelated to the market, which are independent of the company's operations. You don't have to predict too much. These strategies are scalable, replicable, and easily executable. And since the returns are predictable, we are more focused on the event, which is already announced. So there is no risk to the event also. It's a low risk strategy. And we have been doing this under this CapGrow umbrella for last 4.5 years. The returns are superior to all other strategies. We also run a growth strategy. Obviously, this special situation strategy has beaten down growth as well as comparable, flexible, multi-cap strategies, both in the PMS and MF space. Give you a couple of examples. I thought probably that will help you understand how these situations emerge. I will take this first Z Entertainment. So Z Entertainment merger is going on. This is a live merger which is happening already. More than 12 months have passed. We are on the last leg of the approval. The company is in the last leg of the approval, and as per the announcements to the exchange, they are hopeful of completing it by 30th of June. So let us understand what is happening. Z is merging with Sony. So post this merger going through, I will add that caveat. It has not happened. The final leg of approval is still pending. This becomes Sony India Limited. It becomes an MNC, multinational company. That's one. Second, post this merger, Sony brings in cash of 11,500 crore on the balance sheet. So this becomes one third of the market cap of the combined market cap entity. So I will add these 2 points. MNC with one third of the market cap in the form of cash. Next, both right now close to both of the entities have close to 12% to 14% market share. Their combined market share will become 26 to 27%. Just imagine the synergies both on the cost front and the revenue front. When I say cost front, which is easily to understand, which is easy to comprehend, you will have multiple offices, you could probably have multiple people catering to the same segment. So there would be a reduction in workforce or maybe a rationalization of the workforce, rationalization of the offices. Then on the revenue front, earlier both were trying to compete with each other and trying to, maybe squeeze Hindustan Lever. Okay, my trying to outsmart each other in terms of, pricing, and the customers like Hindustan Lever, Godrej were the beneficiaries. Now you have 27%, 26% market share going to an entity like Godrej, Hindustan Lever, and say, if you want advertisements, this is the rate for us. So I believe there would be a catalyst both in terms of earnings, margins, and balance sheet becoming stronger. And on top of it, this company becomes, an MNC. So the earning profile will actually change in the next 12 to 18 months, and this company should get re-rated. This is our proposition. I'm just giving you an example. No thoughts on whether we don't hold or we hold. As I said, this is not a stock pitch. This is just trying to help the audience, the investors, how a merger can transform a company's future. This is a case study on Escorts, same situation. This was not a merger, but Escorts, Kubota coming over and taking over a majority stake in Escorts. They also brought in cash. So now from a net debt company, Escorts became a net cash company. And guess what happened? As I said, these changes in the capital structure and management change brings in change in the outlook, changes in the business profile, and changes in the profitability. So Kubota had a analyst day a couple of months back, and just look at their aspirations. They want to grow their revenue, by 2.5 times by FY 2028. So in 5 years, they want to change it, enhance their revenue from 2.5. They are having currently clocking 10.5% EBITDA margin. They want to, that's their wish list, to take it to 15%. They want to enhance their market share in tractors from 10, 11, 12% to somewhere close to 20%, which is huge. And the uptick in revenues will come from a couple of things. Escorts will gain access to global product know-how. So all the latest technological products will now be accessible to the Indian market through this entity. Kubota will use Indian manufacturing for their exports business. And Kubota has been using China and US as their base for parts, supplying it to parts to across the world, to various countries. And that business itself is $5 billion. They mentioned in their analyst day, that if they just transfer 10% of it in the next 5 years, that will mean an additional incremental $500 million revenues for forest crops. And top of it, for minority shareholders, they promised to return 40% of their profits to be distributed by dividends and buybacks. So improvement in corporate governance standards, improvement in balance sheet, improvement in the revenue outlook, all these factors will lead to a re-rating of the stock in the times to come. So this is the power of the transformational event that has led all these changes in the company. And this is what a special situation strategy we try to look for. These are our NAV trends. It has done better across various timelines. So what is our investment mantra? I highlighted, I gave you in detail what the thinking is there in special situation strategy. Different from plain vanilla, low risk, superior return profile, and hence since the thought process is different. So the stocks that come out of this process are also different. Our top 5 holdings, you will not find it in other PMSs, plain vanilla, value, growth, momentum, small cap, large cap, or the mutual funds. Because these strategies, or maybe they probably might hold only 0.5%, 1%, but we would have a significant weight to these stocks where there are corporate events. We believe that this strategy will still at a very nascent stage in India. There are enough opportunities in the market to take this to a much higher level. As I mentioned, in the US developed markets, this is close to 1/3 of the markets. As markets develop here, we are very confident that we will see more and more opportunities coming to our kitty. So these are some of the things I am sure, what we look for in the second layer: management integrity, corporate governance, moats, if it all there, efficiency, economic efficiency, and structural plays. So this is the summary of how we do idea generation, which gets triggered with the corporate event, and then research and due diligence, which was the second layer. When I said we do a sanity check, operational risk, we normally try to have a maximum cap of 10% in a particular position. And then let the value grow as the company grows, and we reap our returns. I think I addressed most of the issues. Returns, low risk, superior, what is the risk? Risk is just the timeline, nothing else. These are uncorrelated to the markets. That's it, I think, from my side. Would be happy to take questions from your side. Over to you, Apsara.
Thank you. So that was very brief explanation. Thank you for that. So let's start a Q&A session. I think I should give him the first preference because he had questioned before even the webinar could start. So which sector is expected to give more returns in the market for financial year 23 and 24? He's an anonymous attendee.
Okay. So, as I said, we just look for, in this strategy, I would still like to try to answer you. But in special situation strategy, this is what I say: you don't have to predict which sector or which stock. You just have to focus on the corporate events. It goes to the first slide. We are not bothered kaun sa sector chalega. What we are bothered about, where is the corporate event happening? That's where the returns lie.
So when you say that, so where do you see the opportunity, like in the market? Because how often do you see the opportunity in the market for special situation strategy? Because you depend upon the corporate events.
Yes. So there are enough. So we have around 15 to 20 stocks in our portfolio, and right now we have more opportunities than money to invest. And in my last 5 years at CapGrow and when I was doing it, my hedge fund, there are a lot of opportunities. And since these opportunities are not covered by analysts on the street, there are no investors who try to, follow this. These strategies, there are, go unnoticed in the market. Most of us are focused on which sector, which stock, where's the raw material, but these strategies are just focused on corporate events. Just imagine, Z is the large cap which is happening. A scores just happened. There was a delisting offer which has come yesterday itself. Then there is a big merger happening of HDFC Limited and HDFC Bank. Just a merger has happened for a pharma and a financial services company just 2 months back. So there are so many opportunities which go unnoticed in the market and which actually offer you a better risk reward.
Okay. Do we sit on cash on a portfolio?
We normally keep around 5-7% of the cash, but we are not a big believer in keeping cash on the books. We
So,
believe whatever money is given to us from the investors, that is their equity allocation in their portfolio.
so only apart from equity, there's no other allocation.
No.
Any app allocation for a special situation?
So special situation, the right allocation, we normally have 15 stocks, maybe 3, 4, 5% of the cash. And out of these 15 stocks, I would say top 6, 7%, top 6, 7 stocks would constitute close to 60% of the portfolio. So there's a very heavy concentration which we normally have. We try to keep it up to 10%.
Okay, so one question from Kunal. Such special events are public knowledge. Hence, there could be many other traders, investors who could be taking advantage of such situations. Thus, the margins in such trades could be limited. So, how much return can be expected from overall investments?
What differentiates us from others is most of the investors or traders are focused on what is happening in the next quarter, what is happening in the next 2 quarters, what will be the profit number. We are not, this is noise for us. We ignore this noise. For us, when will this event happen? And if the event gets delayed, actually it is beneficial for us because then lot of investors get frustrated. They would sell the stock or the stock will languish, and that will be an opportunity for us because now already 7-8 months have passed. The event has got delayed, but it is just 4 months away and the price has fallen. So the returns for the incremental money would be much higher than on day one.
Okay.
So the margins have not been following, just to answer straight, margins have not been following the stocks. These stocks are still uncovered, unnoticed in the markets, and hence provide you a big opportunity to deep returns.
Okay. So when you talk about the merger and all, so there's a question from BM Joshi. Can you please let me know about the latest position of demerger of BEML, which is like Bharat Earth Movers Limited, and BEML? So if you want to answer it, you can, else we can ignore.
Yeah, since it's stock specific, I would refrain. But as I said, these are normally, we invest only in announced events. That's number one. Second, only timeline is the risk. There is no risk to the happening of the event.
Okay. So when you talk about, stock preferences, so what is the exit strategy CapGrow follows? And what are the parameters you look into it?
Sure. In my 30 years, if you ask me, exiting a stock is much more difficult than entering a stock. When to exit is much more complex. Our strategy at CapGrow is, since it is event based, if it is a buyback, it is a delisting, normally we exit, the market gives us the exit, the company gives us the exit. So that's our exit strategy in those cases. While in case of merger, demerger, we would actually wait for the mergers to happen. And if we are also betting on the changes in the earning profile, we would wait for another 12 to 15 months. We have done a back testing, and I can share with you the phenomenal track record which these situations have, where post 12 to 15 months, the earnings have increased dramatically like how to say. So you need to wait for the 9-12 months for the merger to happen, and then 12 to 15 months for the company to basically organize itself the liquidity and post a superior return profile.
Okay, I think that has answered the other question also. So moving on, how old is the fund and how are the returns over the time? So this is from Neeraj Thakur.
Yeah, so returns, SEBI registered PMS, we started on 1st of November. So we are a little more close to 4.5 years. The returns, as I said, are superior. Even in a market like down today, it is upwards of 15%, while the indices are close to 11%. So there is an alpha of 3 to 4% across different timelines. And we have maintained this alpha throughout. We are very confident that as we progress, as the fund progress, this gap, this alpha will keep on expanding.
Okay, so again, let me go to the macros now. So, of course, India's GDP growth, estimated GDP growth has been narrowing out from 6.6 to 6.3. So we can expect it to narrow it further. Do you have any other perspective from this, or how do you see India's growth?
I think my perspective is a lot of structural changes have happened in the last 5-7 years. Let me pick one structural change, which I am a big fan of. Make in India initiative, PLI schemes. As you know, we saw from maybe late 90s to early 2000, we saw a big leap in IT services from, especially from Bangalore, Hyderabad, each one, from every family, there was one person who was either studying computer or working in the IT field or going overseas. Same kind of big growth is going to come from manufacturing this time. The government is focused on providing, the MNCs the best manufacturing base in Asia so that they can produce here and export. You see the amount of smartphones that have been produced in the last 12 months. Apple is producing close to 8,000 crores of phone every month. So, and these manufacturing has a multiplier impact on the economy. You have higher logistics, you have higher component movement of components, then you have labor. So employment then higher consumption. So just look at the multiplier impact, and the government is clearly focused on making India initiative. So I just gave you an example of one structural change, which makes me very positive for next 5, 7, 10 years. Obviously, it will not be a straight line. It has never been a straight line, and it will never be a straight line. But the direction is upwards. There will be swings on the way. We just have to ignore those swings, and any drastic fall is a big opportunity for all of us to add to India's portfolio.
So with saying that, the other question from Muskan is, what are your views on China plus one strategy? Because you're being very positive on India. And what is the market outlook for the coming year?
See, China plus one, it's very easily comprehensible. Let's say if you are a consumer of something and you have been dependent upon China, post-COVID, there have been a lot of concerns. China is a closed economy. The transparency is not there. So most of the bigger companies, MNC, now they are trying to diversify their vendor base. Earlier, they were focused on China. Now, even at a slight higher cost, they are willing to give a chance to India. And that's where I said India also rationalize their taxes, focus on manufacturing, PLI schemes. That will actually lead to some of these manufacturing being shifted from China to India. And even a small shift will lead to huge increase in revenues and profitability for Indian companies. In terms of macro, next 12 months, I think this year we already saw RBI's action today. We already seen Fed, just hiking it by 25 bips. My personal view is that we are near the end of the tightening cycle. We have already seen signs, maybe one or two here and there, but the focus now will be on the financial stability in the US, and hence we will see equity returns coming in the second part, back-ended this year. Whenever we have seen in the past, whenever the rates start either pausing or start coming down, the small and mid caps do well. I think this time also the same situation will happen.
Okay. Thank you, sir. So one more question from Siddhant is that, so you mentioned generally corporate action gains has nothing to do with financials of the company. But in case of Z, the whole re-rating is based on improved performance. You want to answer this question, sir?
I think, yes, I think I am not here predicting what will happen to the EPS. When I said we are not we are not focusing on the financials, but the focus is on the merger happening, the change in the capital structure of the firm, which will eventually lead to better earnings for the company. So the focus is not how much they will burn on the OTT, what will be the growth in the subscription revenue, what will be the advertising revenue for the next quarter, next 2 quarters. We are not focusing there. That's what I meant by not focusing on the operations of the firm. That's a sanity check that okay, these changes will happen, and then we are not predicting what will be the growth, whether it will be 8%, 10%, 12%. What we are predicting is this is a significant transformational event in the history of the company.
Okay. Okay, thank you, sir. So moving on to the next question from Karthik is, the merger and acquisition happening post-COVID are in a surge of bigger corporates are becoming bigger. So do you think the scenario is a threat to the economy?
If you see, the way the technology is changing majority of the businesses, it is very important for all of us to be efficient. Efficient in operations, efficient, I mean higher productivity, even better, capital efficiency. Smaller firms post-COVID definitely have taken a hit. A lot of them have not been able to allocate capital either to technology or to the changes which are happening around them. Big and bigger companies that have become bigger, they are able to get capital allocated and expanding. And hence, I think this is a change. This is something which will happen, especially in India, that big will get bigger. Even in the US, at one point of time, it used to be you stick to your core business. But with technology happening, with so many disruptions coming, I think majority of the bigger corporations which have better allocation, which are sitting on huge cash, are in a better position to expand into these areas and impact the smaller players. I am also of the firm believer that big will become bigger.
Okay. So when you talk about the technology, so on a broader view, even wealth management landscape in India is having a techno shift. So, and there are a lot of homegrown HNI clients now in India. So we are soon to be millionaires are found in India. So how do you see HNI clients, their risk appetite, or how do you differentiate the traditional HNI from new age HNI?
See, Apsara, just imagine this techno shift is already happening, and that's why you and I are there on the call with more than 100 participants.
Yes.
So we are all connected through technology. This is post-COVID. And now with a lot of direct plans coming in, lot of apps coming in which help you monitor your investments on a mobile. You can invest through your just a mobile, just on the click of a mobile. You don't need a relationship manager. I'm not saying they will die. That's a different business. But a lot of business will shift to these technology platforms. That's my take. And I have dealt with banks. I've dealt with so many wealth firms. These RMs keep changing. So lot of big families, big wealthy guys, HNIs, they are not that comfortable sharing their financial details with the RMs, which keep on changing every 2 years. So they are more comfortable either a family office, which tracks their own investments, or if you are in that medium to higher bracket, having your own app and trying to monitor your investments. So this techno shift is already happening. A lot of mutual funds, a lot of manufacturers like PMS, AIF are already providing, and it also enhances the efficiency. So why not?
Okay. So the other question from Pulkit is, if you could talk about your fund's performance versus Nifty 50 TRI since inception. How, if you could benchmark that with Nifty 500?
Yeah, so we have actually benchmarked again Nifty 500, and as I said, there's an alpha across timelines. I would be happy to share that on one-to-one. Otherwise, it's also there on the SEBI website.
So, okay, if you could share us the performance, so I could we as PMS Bazaar, we could share it with our clients.
Sure.
So moving on, like how do you see PMS industry going ahead? If you want to talk about that.
See, PMS industry, PMS and AIF will have a huge growth in the coming years. And why I said, if you see the US industry, active management, active investment is still a big part of the total industry, even though a lot of funds have been taken by passive like Vanguards. But PMS and AIF give you that flexibility. I have seen couple of portfolios of big mutual funds where the holdings are maybe upwards of 30, 40, 50. But in a situation like AIF, in a situation like PMS, you would have a concentrated portfolio. So PMS AIF platform or PMS AIF gives you that flexibility to own stocks, to own concentrated portfolios and reap returns.
Okay. One question from 𝐮𝐩𝐿 is, when special situation events are announced on a pro rata basis, one might need to exit the position post the event. When it is the prices do not reflect the event, how do you manage such allotment risks?
See, there are sometimes it's a small cap, but post the event, if a lot of people have done it, next 2 weeks, 3 weeks, you might see some selling pressure. But if it's a decently large company and you are betting on that this event will change the earnings profile, then you don't need to sell post the event. But if it's a buyback and you want to sell the residual 20%, then yes, there might be some selling pressure. But as I said, we also apply a second layer, a sanity check. So we are conscious of the fact that only 70% of the stock will get accepted in the buyback offer. So we will have some estimate of the price at which we will sell the 30% residual or whatever we do with the 30% or 20%. This is just a hypothetical number, but we will have some estimate, and we are conscious of the fact that just immediate next to the event date, we will see some selling pressure. So we will try to manage that risk.
Okay, so we'll talk about small and mid caps. So it is, showing a bit of, heaviness in today's market. So do you think is it a good time? Do you think it's an attractive investment now, small and mid cap sectors, or do you think it is going to have an heavy impact moving forward?
See, large caps have not gone down in the last 1 year, while lot of small and mid caps have reacted, have come down sharply. When I say sharply, anywhere between 30 to 60, 70%. And hence, that's where the opportunity lies. Price should not be a factor in your mind when you analyze an investment. What should be there is, what's the value and how much is the price quoting and what's the difference. These small and mid caps, I have always maintained, these are cyclical stocks. When I say cyclical, they move in cycles, whichever company you may take. And right now, I believe with interest rates flattening or maybe with the expectation of coming down, I think small and mid cap cycles is a good area where you could actually dissect and find few good stocks.
Okay, thank you. When you talk about macros, like complete macros, For as an investor, it looks threatening about what's happening in the banks, US, UK banks. It's threatening. So, do you have any exposure for in US or UK? Your portfolio has any exposure there?
No. That's why I said don't focus on what is happening in micro. Come to special situation. Jokes apart, yes, US with three, four banks falling. I think my sense is there are a lot of maybe close to 200, 250 banks which are on the verge, which are in a similar situation where the government is trying to save them. Whether they will or they are not, I don't know. But normally these events are not one-off events. They are a lot of times you will have one or two more events post these one-off events. It has happened in 2008 when we saw Bear Stearns collapsed. After that, a lot of other banks, Wells Fargo, Fannie Mae, then Lehman crisis. So normally there's not one or two cockroaches, there are a lot of cockroaches. This time, the only difference is that the system is not leveraged. Last time the system it was leveraged completely. So my sense is the US, there might be a couple of cockroaches more, but the whole impact will be contained and you will not see the domino effect which you saw in 2008.
Okay. So when you talk about this domino effect and all, there's something called behavioral gap, the difference between the investors' returns and investments return. So when you compare with the data, 2020-22 and 2023, the behavioral gap was high when compared to 2022. So how do you see the 2024? Because that is what speaks about the alpha.
See, 2024, I earlier said that returns will be back-ended. When you say India's GDP is growing at 6.5%, 6%, 6.25, let's not get into that 0.25, 25 bits discussion. Let's say 6% plus 5% inflation. So 11%. And there are a lot of companies which will grow from 15 to 20%. And the idea is to find couple of them, those companies which will grow even in this situation, uncertain times when there are uncertainties on the macro, which will grow at 15, 20%, which will continue to grow for the next 3, 4 years and just sit on them. A lot of times we are just because we are seeing the screen on a daily basis that impacts our emotions, that creates fear in the mind. But if the price is falling on a daily basis, what would a human mind do? He would, we would think, okay, let's buy it tomorrow. Let's wait because whatever I bought yesterday, it's down today. Let's wait. And he will keep on waiting. When the cycle turns, you will not be able to buy. Same situation happened in 2021 when the stocks were going up. Everybody was saying, no, I don't want to sell. I want to buy more. Give me an idea. No, I sold, at $100 last month. It is 140. I shouldn't have sold. But now the stock is 60 rupees. So that's a human nature where you tend to postpone your decisions. My sense is you should always keep a range, buying range or a selling range. We are in that buying range where one should start accumulating aggressively stocks for anywhere between 12 to 36 months time horizon. That return happens in which month, 12 months, 15 months, 24, I have no idea. But right now, the stocks, the valuations are in that comfort zone whereby the risks are maybe 5-10%. Worst case scenario, well, the returns could be 50%. So that ratio of upside downside, we love it. And hence I said we are in that zone.
Okay, thank you. So one more question from Jason is, do you participate in open market buybacks and takeover offers, or do you only stick to trend offers?
Do you stick to the last word? What did you say?
Tender offers. Tender.
We stick to tender offers. Buybacks from the market has no meaning for us. It's not relevant because we don't get to participate. So we will stick ourselves to only the tender offers where we, as a minority shareholder, get an opportunity to tender our shares to the company at a higher market price.
Okay, so we're nearing the end of webinar. So if you could just your career journey from DBS to CapGrow, if you could just give a gist of it for investors.
Sure. So, I was in DBS, 98 currency crisis happened. So I thought probably let me go and do something. Every time I wanted to do something on a big scale. So I went to the US to do a full-time 2-year MBA. I got an internship at Manning Napier, which is close to $30 billion fund. And there I got my final offer, worked there for 2 years. And because of some family reasons, I have to come back. In 2005, I started working with a hedge fund called 𝐼𝐴𝐴 Global. This is run by one of the big distress investors, Mr. 𝐼𝐴𝐴, where I learned the ropes of special situations. He was my mentor. I was directly working with him, and under his guidance and mentorship, I learned the intricacies of special situation, and I realized how this gentleman has made close to $2 billion in his lifetime through special situation investing and distress investing. And that was one single biggest motivation for me to just jump into this area. So I worked from 2005 to 2013, 14, and these 8, 9 years were even we got saved in the 2008 financial crisis. We were also investors, big investors in convertible bonds. So a lot of times we were holdouts, we had significant blocking positions, and we were involved in restructurings. And 2014 wanted to spend some time with family, took a sabbatical of 3, 4 years, managed my own family office. And 2018, because of the returns, courtesy the government, courtesy the markets, I was a little lucky, I would say. A lot of investors, a lot of friends, relatives approached me, why don't you do something for us? A special situation is not, done by others. There are a couple of funds with the name special situations, but if you go by their portfolio, those are not special situations. So I said, okay, I was a little hesitant because I've never handled retail investors. I have always handled institutional money, but took the plunge. I have 10% of the fund is my own money. So my interests are aligned with the investors. And we follow a philosophy of HIT, honesty, integrity, and transparency. So we are transparent with our investors, what we do, how we do, why we do. And so far, the journey has been very sweet.
Okay, that was quite, of course, it is inspiring for many of that. So, investors could get to know about you more. So with that, we have come to the end of the session. Of course, there are a lot of questions which is unanswered. So I would request the investors to, mail it at events at PMS Bazaar. I'd request Mr. Arun Malhotra to answer them so that, the unanswered questions are answered, at least in the mail. Not if
Sure.
not the mail.
Sure, Apsara. There are still 42 I see question and answers. And I'm sorry, because of the paucity of time, I couldn't answer all of them. But if you email it to Apsara, we would be more than happy to answer and even get on to a call with each one of you to help you understand what we do at CapGrow. Once again, thank you, PMS Bazaar. Thank you, Apsara. And thank you, each one of you, for participating in this.
Yeah, thank you for spending your time, sir, on a Thursday evening.
Sure. Have a good day, good long weekend, and enjoy. Thank you.